Fed Chair Jerome Powell saying there was consideration for pausing rate hikes, but ultimately the Fed decided against it. Here's Chair Powell on why there was not a pause.
It was supported by a very strong consensus, and I'll be happy to explain why. And really it is that the intermeeting data on inflation and the labor market came in stronger than expected, and really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year, more than we'd expected at the time of the SCP in December, the time of the December meeting. We are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that we'll bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words.
All right, for more reaction to the Fed decision, we're joined by Rebecca Felton, RiverFront Investment Group Senior Market Strategist. Nice to see you. So your reaction to the hike and to the tweak to the language, which emphasized additional policy firming ahead.
Well, thank you so much for having me, and not to sugarcoat it, but it was really nice to not have any surprises out of this release today, nor Chairman Powell's comments. We have been of the belief that they would have to continue to raise rates. Those inflation numbers are still way above where they want them to be, with that most recent core CPI coming in at 5.5%, and the PCE numbers also high. So it is going to take a while for them to get that price stability to a number where they want. And I believe when you think about what has happened in the recent weeks with these banks, very specifically, each of their problems have been very specific to them, and it doesn't suggest necessarily any type of contagion. So there will be more scrutiny, but we believe that everything we heard today was in line with expectations.
Rebecca, that new language in the statement, though, really does convey some of the uncertainty out there just in terms of the stress that we have seen within the banking sector. How are you looking at this from a market perspective and really the ability or the risk there that it could affect the economy down the line?
Well, you know, the implications down the road, aside from greater levels of scrutiny, particularly as we think about some of the regional banks, could be tighter lending conditions, which has impacts for growth, both for small businesses as well as consumers. And that would obviously have some impact on growth expectations going forward, which calls into question whether or not earnings estimates still have to come down further. We believe that estimates probably have already been revised enough. Obviously, we're headed into Q1 earnings season very quickly. It's hard to believe March is already over. So what we'll need to be paying attention to, obviously, are CapEx plans, hiring plans, and just some of those cost pressures that companies have been seeing, whether or not those are easing at all.
Leading up to this, a lot of discussion about whether or not Powell would focus on inflation and price stability or stabilizing this banking crisis. In your perspective, does the 25-point hike have any impact on the banking crisis as we now know it?
I believe it's too soon to tell that. Again, when we think about some of the policies that they've put in place with the bank term funding program, obviously that eases some of the tensions that we have seen with some of the smaller banks. But this was in line with expectations, actually, maybe a little lowered expectations than where we were even a month ago. So I think net, we have been in an environment where we expected these rates to continue to go up as we move further into the year. Companies have adjusted to that. Estimates have been adjusted for that. So really, again, nothing really new today.
Have you shifted your strategy at all, given the recent events over the last couple of weeks, or anything that we heard from Powell today?
Well, we had already earlier this week, last week actually, we did reduce our exposure to U.S. banks, specifically our exposures to the regionals. We're probably neutral to slightly underweight U.S. banks, but we have an overall neutral weighting in financials because we have some European financials as well across our strategy. So we did take some steps on those regional banks.
And how about the larger banks?
We're still neutral there. Again, lowered our exposure somewhat. We had been overweight, so we've pulled that back in just slightly. We are neutral equities in general because we believe that there are still so many uncertainties around growth But if you think about where the market is priced right now at 17 times forward earnings, there's a lot of expectation for a resumption of positive growth in Q3 and Q4. And then looking ahead to 2024, since we do have that look ahead bias, there would be a clearer resumption of growth across many sectors, not just a few.
And as for the probability of recession, Mr. Powell said it's hard to see that this banking crisis helped the likelihood, but a pathway to a soft landing still exists. Has this last few weeks changed your probability of a recession?
Well, we had been expecting that we could have a global recession in the back half of 23, maybe early 24. But then you look at that or could compare that to where GDP now is for Q1, 3.2%, I believe, quarter to quarter annualized. And then again, growth in the first half of this year. So we're not looking at any data right now that is pointing to a recession. When you think about GDP, when you think about the employment situation, the consumer resiliency, the fact that home builders are feeling better, there's a lot of positive things going on underneath the surface in this U.S. economy.
Rebecca, what do you make of the current employment situation, the fact that the labor market has remained so resilient? We heard Powell talk about that again, saying that the labor market is still too tight. What do you say?
Well, clearly, we know that they expect it to change. I think that they took their unemployment forecast up just modestly in this newest release, but still yet it would be a little higher than where we are now. And that would be expected when you think about the fact that if things do soften a little bit, we've already seen wages start to come down some, and we've seen prices start to come down some. So maybe the situation for employers won't be as bad as has been expected, but we also know that a lot of jobs aren't getting filled that have been posted for quite some time. So there are a lot of mixed signals as we look out over the next several months on the employment front. But the good news for consumers is more of them are employed, and that does bode well for the economy.
Yeah, we're still around 2 workers per every available job in this country. And at 3.6, does it have to break to get inflation down to 2%? And if so, what's going to do that?
I don't know that I have a good enough crystal ball to predict that per se. I wish I did. But I think, again, a lot is going to ride on how tight these bank lending standards get for small businesses and consumers specifically. When you look at the chunk of GDP that consumption is, I think that that's going to be a really important component as we go through the next few months and into the end of the year as it relates to whether or not we have a recession. So there's a lot of uncertainty, which again goes back to our neutral positioning and our strategies.
Rebecca, where do you see inflation right now in the current path that we are on by the end of the year?
Well, you figure, again, CPI is at 5.5%. It is hard to see it going significantly, maybe below. Again, I hate to predict, but when you think of the trajectory we've been on already, it would be hard to get it below 4, I believe, if we were to stay on the current path.
Okay, Rebecca Felton, appreciate that. Thanks so much.